Good afternoon, everyone. I'm Stacy Scott, and I'm the Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm also your host for today's webinar. We have a really great session planned for today. This is something that's a little bit different than what we normally do. We have been asked a number of questions over the past several weeks from some of our clients. And what we have elected to do is answer some of those burning questions that you all have in today's Lunch and Learn session. As always, you're going to see Graham's calendar pop up periodically throughout our session. And if you would like to schedule some time with him or anyone on the team, just click the day and time that work best for you, and we'll get that scheduled. Also, we're going to have more questions at the end of the session. So some of these topics may pique your interest. You might want to know a little bit more. Feel free to get those questions into the Q&A section of the chat box, and we'll make sure to answer those for you. And with all of that wrapped up, I'm going to turn things over to Graham.
Hey, thank you, Stacy. Thank you to all of our viewers and listeners for being on the call. Thank you for our clients. And I think, we were talking about how do we want to handle this today, right, Stacy?
Right.
And I think we wanted to try to just have like an open forum, right? And just kind of chat about some of the burning questions that we usually get asked the most. And kind of address those for everyone on the call. So I guess let's go ahead and jump in. First off, let's just start with market commentary, kind of where we're at. Maybe where we're at, maybe a better introduction is where do we come from, right? Last year was such a challenging year. I think that's without question. With COVID, war, we have a Fed trying to fight stubbornly high inflation up in the 9% range. So raising interest rates, the fastest pace ever in history. And everyone has kind of figured out anything that was growth or earnings in the future. So those high growth names really took it on the chin last year. We saw some sectors, some sides of the market, some individual stocks, 50, 70, 80% down. At the same time, we saw some sides of the market, let's say like oil, really shine. And so what does that mean for this year? Well, looking at where the averages ended up last year gives us perspective on why we're seeing what we're seeing a bit this year. So what got hit the most last year is what's bouncing back the quickest. There's a little more caveats to that, and I'll add to that in a second, but let's think about it. If growth and tech, things that would have earnings in the future were hit with bonds. Bonds were absolutely annihilated. I know that's not a great financial term, but I think it's fair to use. Worst performance ever in history. And it wasn't that we were seeing increased credit or defaults in credit, which would be in the bond category. It was the pace of interest rates, right? The fastest ever in history, moving up so quick, so fast that older bonds had lower coupon rates compared to new bonds being issued. So they were selling the old to buy the new. And then obviously some additional fear out there, so on and so forth. Earnings in the future for these high growth names, higher interest rates hurt their earnings power today, or companies in that industry or that need a lot of debt to function. So again, I know this is kind of a 10,000 feet up comment on what really went on, but that's pretty much what happened. Now, we didn't see the recession that everyone was talking about, but it doesn't mean that the concern isn't there. And sooner or later, they're going to be right. If you've been on our calls before, we always go in and out of recessions. They're not uncommon. So we need to expect that some of this is just going to happen over time. So that didn't really happen last year. Doesn't mean the economy's not slowing. Doesn't mean the pace of the consumer is not slowing a little bit in terms of their spending habits, but still elevated. And that's kind of what we're seeing this year. We're seeing kind of a reversion to the mean. We're seeing what underperformed the most last year, kind of outperforming a bit. You throw a little AI on that, and boom, you have tech, anything AI related or presumed to be AI related, really outperforming this year. Where you might have more of the value or the more steady Eddie, maybe a little more boring, underperforming comparatively. And again, I don't want to get into overly too soon, too quick on our expectations for the future, but we obviously do think that that's probably going to right size a bit as the excitement kind of dwindles down a little bit, but not necessarily going away for the tech and the AI trade. So let's kind of break down where we're at year to date. I mean, we're looking at the NASDAQ up about 30%. I mean, absolutely monstrous move in that side of the market, driven by tech, those growth stocks that might have more AI play to them. The S&P is up about 10%, about 8.6% year to date. Think about this. The S&P is a cap-weighted index. So the largest stocks that make up that index are going to hold a bigger weighting and have a bigger, carry forward performance for that index. So if we look at it from that standpoint, you probably have about 7 stocks that are making up roughly 90% of the return. You could go ahead and paint and say somewhere 9, 10 stocks because their size is so large. NVIDIA and Apple and Microsoft and Amazon and so on and so forth have moved up so quick, so fast, and the weighting is so large. 7 to 10 stocks are making up, really all of the return that's happening in the S&P. So I guess what I'm dwindling down to is that basically it's a very defined market in a very specific area that's outperforming. It is not broad-based. Obviously, we would love to see it broaden out. We know it will broaden out. And when it happens, it happens. But right now, AI, those high growth names have the market for maybe multiple reasons, but also AI, reversion to the mean, and maybe just a trade that they feel like they don't need to go to the credit markets to get debt because their balance sheets are so big, they can self-fund. And I think you add all that together, that's a bit why we're seeing some outperformance. Doesn't take the concern of a recession off the table, but maybe lightens it a little bit because our focus can be put on something else, right? So that's kind of what we see, obviously year to date, and it's been a pretty interesting year to date, just on that standpoint. If we're looking at, let's get into some questions, Stacy. Let's start going over those. I'm going to see if I can drop my picture down a little bit if it lets me. But can you define, or can we talk about maybe investing 101 information? So basic definitions of growth stocks, value stocks, small caps, large caps, and bonds. And what role do they play in my portfolio? And thank you to one of our clients and listeners for getting that in. So let's take a look. So let's get into basic definitions. If anyone's been to the class that we teach a multi-day retirement planning course. We really get into the basics of defining what each one of these securities and what do they mean, because we really have to understand what they mean so we can really understand what role they play and what to expect out of them. Right. So let's think about growth stocks. Growth stocks are probably going to be your more aggressive area. They're looking more primarily for capital appreciation. So they're taking the earnings. Let's say they're putting them back into R&D and looking to grow instead of distributing them out to shareholders. Right. So you might see companies that are certain types of sectors or industries that are designed to pay out a portion of their profits and revenues, or they might just be a more established, maybe a value type approach, where they're underappreciated and maybe we're underloved and we're expecting that their future valuation isn't fully being realized today. So you're hopefully buying low and selling high, as we're always trying to do when we're thinking about, buying and investing. But they might be a little bit more inclined to pay some income out. That might be the overall structure of them, so on and so forth. We think about small caps, think about them as like the sports cars, right? Not always the newest. Maybe they just haven't ever reached the status of an Apple or a Microsoft or an NVIDIA, so on and so forth. But we're talking quite a bit smaller valuations, 250 million to 2 billion, younger, maybe less established. Maybe they just haven't grown as fast, probably less likely to pay income out, more US focused compared to their large cap brethren. And we can get into the small caps, mid caps, large caps, mega caps, all that, but we're just kind of keeping it a bit general, a bit simple for all these slides are part of today's Lunch and Learn. But let's think about large caps. Large caps are much more established companies, maybe about $10 billion in assets or higher, perceived a bit more established from that standpoint, maybe a little less volatile, not always, but possibly a little less volatile, and maybe pay out a little more income, maybe a little more global focused with large cap stocks. Then we get into the other side. So you have like owning like stocks, right? So they're asset. And then you get loaning, which would be like bonds, which are basically debt securities. They're kind of like an IOU, and that's issued by the government, municipalities, and corporations. And I know for many of you on the call, you might be like, hey, Graham, I get that. But we want to address their question, at least start out with some basic definitions, because it's important to understand because each one of these components are going to make up your portfolios that are hopefully designed to achieve a goal and objective over the long term, right? So now we got to think about, what role do these play in the portfolio? Well, they create diversification, right? Many times we want to try to mitigate risk or lower risk, right? So maybe we have shorter duration bonds of higher quality to lower risk. Maybe we're not expecting as much return, but just a return of the money and a slight higher return. A little different in today's environment. But yeah, so maybe shorter duration securities for that lower risk side. Maybe we want some more small caps and mid caps and growth type stock investments, for maybe that higher risk, longer outdated investments. So if we think about, how could they play a role in a general, from a general sense? So let's think about it. Any plan and strategy that you have to figure out what your primary goals and objectives are, right? What are you trying to achieve, right? And when do you need to achieve it? What's your time horizon? So you might have shorter term time horizons. That might be to pay for a car or a roof repair or college or mortgage. You might have longer term time horizons. Say it's retirement, and we need to have money to supplement our goals and objectives for those years that we aren't working. We're just looking to enjoy all the years of our hard work, right? Then we got to think about our risk tolerance. What can we stand, right? And everyone is completely different. This is not an exact science, but it's one of those where you got to listen, you got to think about your goals and objectives, your time horizon, and what volatility can you stand to get to that performance that you're looking for. Because some appetite for risk is a lot less than others. And it's not always defined by age. Sometimes it's just defined by how comfortable you are with the ebb and flow that we always have, right? So here's our, let's break out the old bucket strategy here. So basically what we're trying to do is based off our goals, objectives, our time horizon, our risk tolerance, we're trying to categorize what might fall in certain buckets. And let's say we just break it up into three primary buckets. Maybe your short-term bucket, 1 year to 2 years. Maybe you need it for the project. Maybe it's college. Maybe it's to cover 1 or 2 years of your income in retirement. We want to be really safe with that stuff. And today we have opportunities that we just haven't had over the last decade with CDs and money market and those type of instruments paying 4, 5+%. We just haven't seen that in so long. So you've got more options today. Now, will they always be that high? No. But for right now, they're there. So we have options and we can take less risk. So your shorter term bucket needs to be very low on risk as much as possible. Cash, money markets, CDs, short duration fixed income, let's say of government instruments, right? Of the United States government, something like that, since we've never defaulted on our debt. I know we're right in the middle of the debt ceiling talks, but that's been the case in point in the past, and I believe it to be true in the future. So our intermediate bucket, let's say 2 to 5 years, right? And everyone's buckets are going to look a little different. Maybe that's where we start bringing in some of these maybe more established large caps in the growth arena, maybe a little more value, maybe some intermediate. So they might be bonds that aren't maturing in 3 months, 6 months. Maybe they're maturing over a year or 2 or 5 years, that intermediate bucket, we could even say as we're starting approaching 10 years. Then we think about our long-term bucket. So this is the stuff that we can stand to have a good bit more volatility because we know in the longer term, we can afford to take that ebb and flow because, the expectation is that they're going to have higher returns. And this is where when we're thinking about how our portfolios are managed, and this is definitely how we think about it, is that, okay, that's where small caps, right? These sports cars, if you might, and maybe these sedans and mid caps and the large caps. I'm using horrible analogies. Might be like a bus as a vehicle type analogy, and then maybe emerging markets and lower quality debt, right? So maybe we buy below investment grade or intermediate or just lower quality debt that might pay us out a little more income, might give us maybe a little closer to stock type performance with what's called maturities. And then maybe we go out longer on that. So the longer you hold debt out, right, theoretically more risk you're taking, right? So maybe we increase those years, 10 plus years, or up, you're right around 10 years and a little bit longer in that standpoint. So I hope that helped that individual out with that question. Let's jump into the next. Where is the best place to park my emergency funds? I think it's going back to that first bucket. I mean, we really prefer you not to mess around with the stock and bond market in the truest sense. Bond market. I think we really want to look at short duration, government-backed issues that's maturing really quick. Right now, you can get paid really well, and I think that's great for your ultra short-term money, your emergency that you have set aside if you're laid off of work or those projects, home improvements, so on and so forth. CDs. I mean, I haven't talked about CDs and money markets in almost 30 years to the degree we're talking about them now, but we haven't been as interesting, right? So we're looking at CDs and the money markets or money market type accounts, can be the place that you park that cash. And just plain old cash. You could, but with instruments that are backed by the government, very short durations, maybe you get FDIC or the money market type vehicles like money funds, where you can expect ultra safety. I think you can expect a bit better return and have the comfort that at least you're making a return on your money where you're not in cash. All right. But that was a great question. We get that all the time. Like, what do we do? Right. So let's think about this. How long does it take for the markets to recover? So, that was kind of one of the questions that we had from a viewer and client. And I think we kind of clipped in some of these questions. I do want to preface that some of them seemed a little personal in nature. So we're reaching out to you just to have a personal conversation because everyone's different. Your goals and objectives and your risk tolerance is really different across the board. So not one portfolio fits all. So we got to keep that in mind. But how long does it take for the markets to recover? Again, there's no crystal ball in terms of the future, but we can look at the past to kind of give us some clues, some idea of what to expect. So 12 bear markets since World War II, average decline of roughly 30%. So a bear market is 20% or more correction, right? 30% over 14 months. And it's taken about 24 months, say peak to trough, to kind of come back, right? We're well over a year in this, depending on when you are calculating when we started a bear market, if you want to throw a potential recession, because we are having recessions in certain parts of the economy, just not the economy as a whole. If we look at corrections, so corrections, let's say 10% or less, or just under 20. So they're not considered a bear market. We've had 26 corrections, don't happen all the time, but they happen, right? More than bear markets. 26 corrections, and they average decline of about 13.7% over 4 months. They've taken about 4 months to recover. Now, what we've also noticed is one thing that I don't have a slide for, and maybe we should have found it, Stacy, is let's think about this, the efficiencies of the market. The market not necessarily has a lot less volatility, but the efficiency of the market to find disconnections and move from one side to another side, say growth to value, from tech to another sector has been unbelievable, right? So the amount of time for the market to be more efficient and where it wants to be and position itself as a whole has increased. And again, we don't have a great slide for that, but I think that's something to keep in mind. How have stocks historically performed in election years? I know we're getting up to that next year, and I know that's a lot of concern. let's think about it. We got debt ceiling, right? We got the wall of worry here. We should have brought up that old presentation. So we got a wall of worry. We got a debt ceiling issue. We still have stubbornly high inflation, even though it's coming down, right? So we got inflation about 5.6% non-core. It was over 9, so it's coming down. We actually think there's more and more things going on in the economy for that inflation to come down even more, so that we don't feel that the Fed has to be more aggressive. Hopefully they'll take our cues on that and not be more aggressive. But we think that rates might stay higher for longer, and that can do roughly the same thing as just increasing those rates. So how have stocks performed in election years? Let's get back to that. This might really surprise us, right? Because we all have differing political beliefs. And I'm a huge believer is that I respect everything that everyone has, and we want to listen. Everyone deserves the right to believe whatever they want. And again, there's no crystal ball here, but if we look at 17 election years since 1950, stocks are positive 82% of the time in presidential election years, 69% of the time in non-election years, right? Where we're at right now, and 72% of the time in all years, election, non-election years. So the majority is the market's up, right? But this might surprise a lot of our viewers and listeners, but 82% of the time in presidential election years, it's positive. So let's look at the median returns on that, or let's just look at the average return. So election year's performance, the market's averaging at about 6.73%. All years, not including election, for the S&P since 1950, about 8.9% average, and non-election years, about 9.6. So obviously the election does cause some concern, but not necessarily more volatility, because our assumption is during election years, it's going to be a lot more volatile, whatever our political belief is, and we just think that that's going to happen, and it's going to cause a lot of drama, at least in the interim. And that doesn't seem to be the case, at least going back to 1950, where we saw volatility at about 14.16% compared to the other years at 16, almost 16.5 and 17, right? So hopefully that clarifies a bit, at least what the past has shown us. We'll just have to see if that repeats in the future. But I often believe that history leaves clues. It has some sort of rhythm and rhyme to it. And anything that might be outperforming in one period will revert to the mean, right? And kind of meet some of the others in terms of performance, like growth over value or value over growth, in certain sectors, so on and so forth. So how can I make my portfolio make some money in this economy? Here's our crystal ball, all right? Think about diversification. Think about not having all your eggs in one basket. What is working? Well, the risk list, at least from the stock and bond market, money markets, and CDs for that ultra safe money. But we know with a longer term view that if growth stocks are outperforming right now, tech focused, AI focused within that tech sector is outperforming so much right now. And what do we have underperforming? Value. Well, that would kind of lean us to say that if everyone's crowded on one side of the ship, sooner or later, so the ship doesn't tip over, hopefully everyone gets where I'm going at, they'll start moving to the other side. And that's what we feel is going to happen. We've had a tremendous performance in the indices. The Dow is the only thing that's, I think it's down about 1%. But I think one other interesting thing to bring to light on the crystal ball and that ship analogy is this. Going back to my previous statement, 7 to 10 stocks in the S&P, so it's cap weighted, is making up what, 100% or 90% of the returns. That is a massive concentration in a few names. So reason you should expect a broadening, right? For a healthy market, you might have a concentration for a period of time, but for the healthy market to continue to move forward, which at least the odds are that's going to happen based off the past, we'll see a broadening out in what sectors have underperformed in those areas, just like tech in 22, might be the ones that start to outperform while they give up some of the gains that they started the year out with. All right. So general bonds have been up this year in general. Now, I'm not getting into the performance of, stocks have generally been up, but it's been more growth focused than value focused. We think all of those play sides, we think they're all going to do well, but we do think over time, certain sectors outperform. Going back to 1927, I know I throw all these stats out, but we like to use history as some sort of guide or give us some clues of the future. And I don't, you always have the ebb and flow of what's in favor and out. But if we go back to 1927, and this might surprise a lot, the value, that more conservative play, maybe a little more out of favor, a little more boring that we talked about between growth and value, that's outperformed or that's beat growth by an average of about 4.1%. And I think over the last decade, if I'm correct here, over the last decade, we've had value underperforming growth a bit, at least of late, right? Especially this year. So it's reasonable to expect in the stock world, from a general sense, growth is probably going to continue to still do quite well, but maybe value starts making up some lost ground here. All right. And now let's jump in, Stacy, to some questions and answers. I think we got about 4 or 5 minutes left.
We do. And we have gotten a couple of questions in, so I guess you have piqued some interest here. How do we think interest rates are going to continue to affect the market?
Well, it's not, definitely not. High interest rates aren't great, right? Because it increases borrowing costs, can lower profits and revenues, because it costs more to get those loans to build the plants or whatever it might be, right? Mm-hmm. But I think it's our interest rates going to continue to increase. Are they going to stay high? You're right. Here's option 2. Maybe they just stay high, but they aren't increasing. So I'm saying the Fed funds increasing rates. Maybe they stop and pause to see the effect. Hopefully that's where we're at. And then maybe they keep them up a little bit longer, right? Because we already know that's affecting. Look at the housing market, right? So if you have a home right now and you got 2%, I saw on someone's mortgage the other day, or 2.6%, or even 3%, what's the likelihood, if you don't have to, that you're going to sell your house and go to a 7% on a 30-year?
Right.
Right? That's going to be front of mind. So you might be hesitant to do that. So we're seeing the new housing market, like new homes on the market, new construction, that's selling like hotcakes. The existing home, we have a very low supply because people don't want to leave those rates for those higher rates. So take that and spread it out. That's what's going on. We're already seeing effects and cracks in the system. Looks what was going on with the regional banks and their debt that they have to have on the books to cover deposits and all that's going on. So it's already having negative effects. We're already seeing certain sides of the market starting to pull back, consumers starting to pull back. So I think those high rates that we're at right now, which aren't crazy, by the way, we just haven't seen them in so long, is having the effect. And I think it will continue to moderate the economy, moderate the consumer. We're not expecting a deep, protracted recession, maybe a light one. We've said that all along. But at unemployment at 3.4%, you're not going to have a deep, protracted recession, at least not our perspective.
Okay. Well, Graham, you've touched a lot on tech. And so I have a question with regard to that. Can you provide information about the current state of the tech industry, including potential signs of a tech boom or bust?
Well, I'm certainly not a tech analyst or an analyst at all, but, on that side of the market, but, let's kind of use what's going on right now. Technology is always going to be a part of our lives, right? If we like it or not, it's going to be a part of our lives. If we want to use it or not, it's still going to be a part of our lives. It's that constant evolution, right? And now we're seeing that evolution in the computing power to the generative AI, right? These things that are coming out now that is going to make the systems that we use more intuitive. Maybe it can think ahead. Maybe it can learn. All these things are coming up in the forefront of AI. AI is not new. It's just the learning capacity to think for itself is what's evolving right now, and the companies that are involved in that. So I think if you're looking at the largest tech stocks, think about their balance sheets. I mean, you have Apple at almost $3 trillion company. I think NVIDIA tapped at almost $1 trillion, first chip company there. Think about, does Apple need to go get a loan to help fund its growth? No. Are everyone just going to get rid of their Apple phones just because they feel a little bit stressed with their job in the market? probably not, right? These things are kind of attached to us by now. So I think if you start thinking about things that way, you can see how they can continue to do well. Now, they'll do well until well doesn't justify what they've done. And I hope that's not too opaque in what I'm saying, is that sometimes the valuation is going to get to a point where it's just, wow, it's just not justifiable. And I think in so many of these things that maybe that's a little bit of where we're at. It doesn't take away from what that's bringing and tech's bringing, but to a point, you got to say that this is going to be something that's going to happen over time, not overnight. And we're trying to bring the overtime into overnight. So sometimes things get a little overpriced. That ship gets a little crowded on one side. Hence my statement that you might start seeing some things broadening out in the markets here soon. Definitely like in the bond market and some of those other fixed income instruments.
Okay.
You got
well, thank you so much, Graham. And a big thank you to all of our clients and friends for sharing these questions with us. And hopefully Graham was able to shed some light on some of those questions for you and that you're walking away with better understanding and some valuable information after today's session. I want to remind you that you can get current market updates from Graham every Monday on our weekly wrap-up. And so we ask you to tune in to those to get the most updated information on everything going on in the market. And also just wanted to remind you that we have one of our favorite events of the year coming up in just over 2 weeks. Our annual car show, and this is our 4th annual car show, coming up on Saturday, June 17th. And it's going to be from 10 a.m. to 1 p.m. And we're expecting a number of cool vehicles to be on display. And we would love to have you join us, whether you have a car to show or you want to just take in the sights. We're going to have refreshments and prizes and fun, just like every year. And all that we ask is that you bring non-perishable food items to donate to the Center for Family Resources, which is a great organization right here in Cobb County that we're proud to partner up with. So check out our social media and our website for more details, or feel free to give us a call. We'll be happy to give you the rundown, and we hope to see you there. Thanks so much for joining us today, and we look forward to seeing you again soon on our weekly wrap-up, next month's Lunch and Learn, and hope you all have a great afternoon.
Thank you. Take care.